and welcome to the latest edition of the Beyond Your Money podcast. I'm your host, Mike Dukovich. Today, I've invited our fellow partner and YTS advisor, Mitchell Niderstros, to the show, and we're going to talk about something that is very near and dear to my heart as a father of three. And Mitch, I believe you have some children, right?
Yeah, one son.
All right, one son, and we're going to talk about how we can save money for their future. So thanks for joining us.
Look forward to being on it.
So, Mitch, what we're going to talk about, there's various ways of saving money for kids, and that could be for a parent or a grandparent or an aunt and uncle. You know, we get this question quite a bit. I have an extra dollar that I want to give to a child. What are the ways we can do that? A lot of people think there's one or two ways. You know, there's really endless ways, but there's four main ways that I talk about with my clients, at least, as far as how to put money away. And I presume you have the same experience.
Yeah. There's about four different ways I think I can think of off the top of my head. You know, and depending on the goals that the client has, you know, when they want the child to have that money, things like that. What's the purpose of the money? You know, what is it going towards?
Yep.
You know, those all factor into that decision. But I'm right there with you. It's probably about four I can think.
Yeah, and you know, truth be told, a lot of parents want to be able to help their children financially. They want to be able to put money away. The first thing I always tell a client, whether it's usually a parent or certainly a grandparent, is rule number one: you want to make sure that you save for your retirement first. Okay, that's usually a rule of thumb for me. You don't want to take that dollar that could be contributing to your retirement unless you know and you're fully comfortable with the fact that you're buttoned up. You know, if your financial plan needs help and that extra dollar can go towards you in your retirement, that's usually the first thing I talk about.
Yeah.
Don't even bother saving for the kids unless your financial plan is secure.
100%. And that's one of the reasons when we first start working with a client, and even as we continue working with clients, we're constantly revisiting that financial plan to make sure, first and foremost, as you said, the long run retirement picture is set up and ready to go and good to go.
Yep.
And from there, once you've established that you have that flexibility to look at the other goals, we can consider branching off onto things like saving for kids,
Yep.
right, or insurance or whatever it may be. But yeah.
So that's a huge point. Let's assume for the conversation we're going to have today that we've already done that work. We've already done that analysis. These clients are buttoned up. The retirement plan looks great, and they have an additional dollar they can do something with. Let's make that assumption moving forward. Okay. So you mentioned it earlier. The word is goals. What are the goals? So, you know, I think when we're talking to a client about the money they want to give to a child, what is the goal? Is the goal for education? Is the goal for a wedding or a car? Is the goal for just rainy day fund? You know, so that's the first step. What are the goals, you know, that you want that money to accomplish? Let's assume, you know, they just want something quick and easy, somewhere to put money, somewhere, you know, that's safe, available, accessible. Usually the first place I talk about is just a simple savings account or a checking account at the bank.
Yeah, 100%. And I think of that as being similar, of course, in a banking form to just like your first piggy bank, right? So I know for my son, I have a piggy bank for him. I don't know if he quite understands that yet. You know, he knows what it is, but doesn't know what it's for. Similarly, as your child gets older, it's good to build financial discipline by ways of saving, right? And teaching those habits early to kind of embed that. And then at least as a father and as an advisor, those are kind of things that are important to me. So naturally, I relay those things to clients. But yeah, the savings account is really, you know, we think of that as a first step, right? It's getting money in an account, teaching your kid to save with some discipline, and then, you know, for current purchases, right? Things that are maybe coming up in the near future.
Yep.
Maybe you know, your son or daughter wants to buy a video game station or whatever it might be,
Sure.
right? Teaching them they have to save for those goals, not necessarily run to credit or debt or just go make impulsive decisions. I think it's a good tool for those shorter term purchases.
Absolutely. And they're typically very easy to set up.
Yep.
They're typically at a bank, right? So you would have FDIC insurance on top of that. They're liquid, they're available, they're accessible. Now, you're not going to get any growth, right? You know, you're really not going to have any investment opportunity there. It's more or less, as you put it, it's a piggy bank. It's just now it's in a more formal way. And I love your analogy about the piggy bank. That's something, you know, there was a point in my career when there was a child born in a family, one of the things that we did is we gave a book in a piggy bank,
Yeah.
to help clients teach that new child about saving and investing. So I love that you're doing that as well. So, that's one of the easier ways of doing it. Just a traditional checking or savings account at the bank. You're at least starting to educate and get them used to saving and putting money away.
Absolutely.
And I love that you're doing it with a goals-based approach. Do you want that, PlayStation or that Xbox or whatever they're, playing anymore?
Yeah.
And this is a way to strive to achieve those goals.
Yeah, and sometimes we'll have parents that receive money, maybe a lump sum of money, what we'll call it a tax refund, or other various ways, and maybe they have an expense earmarked for their child, right? Whether it be hockey, travel team, or whatever. Things are expensive just for kids in general. So it's a good short term way for parents to just kind of earmark and set money aside for maybe expenses they have to budget that specifically for their child, even if the child's not involved necessarily in the savings.
Love it. Love it. So, that's an option. I also, I don't have any, we'll say personal experience with these, nor do I have one to recommend, but I know there's several, but there are online apps, right? App-based services where you can set it up for a child, where you can earmark money. It kind of flows through to this app. And now you're also teaching the child about, just the digital finance. And as I understand it, you can save and invest in certain ways there, and ultimately allocate certain dollars for certain expenses coming up. So, there's a lot of new digital media type of investment tools that you can use. I can't recommend any specifically, but, those are options as well.
Absolutely.
Let's talk about the elephant in the room when it comes to saving. This is kind of the second thing that we always talk about. And usually most of the time, this is one that I tend to recommend after assessing goals. And that's 529 college savings plan. So a 529 college saving plan is a tax benefit, okay, to those that are putting money in. And it depends on the state, okay, for which you live. But for instance, in Pennsylvania here, the giver of the dollar into the 529 plan does get a Pennsylvania state deduction for that. So there is a tax benefit on the front end. This money goes into a vehicle with a custodian, and there's all sorts of different custodians. Now they are tied to state plans, so that they're kind of associated with a state. For instance, the American funds, they are tied to the Virginia state 529 plan. I believe John Hancock's plan is tied to Alaska's state plan. So depending on which custodian you go with, they are tied to a state plan, which is relevant with regards to your state tax deduction availability. Now, in Pennsylvania, it doesn't matter who you go with. You can get that Pennsylvania state tax deduction from everybody. It's a reciprocal state in that regard. But that money, again, that goes in, you get a tax deduction on the front end. You get to choose the investments. So, you can have everything from very conservative to very aggressive. We can talk about that a little bit. That money will grow. You can add to it over time. And then theoretically, on the way out, if it's used for a qualified educational expense, it comes out tax-free. Okay, so there's a little bit of tax benefit on the front end. There's tax benefit along the way, and then it's tax deferred, and it's tax-free if it's used for qualified educational expenses. So this is a great way of putting money away for folks that have an educational mindset.
Yeah.
Is this something that you typically recommend as well?
100%. And to your point, it's normally one of the top pieces of information we discuss when going through these strategies. Quite honestly, the government had set these accounts up because, as I'm sure we all know, the cost of education is rising quickly and significantly.
Yep.
And so, how do you combat that, right? How do you not only put money away but keep money growing towards that future goal of funding at least part, or for some people, all of that education, if that's a goal of theirs? And it's by means of investing, right? And so the 529 is really neat in that you can, could create a custom allocation within there. There's something called target date funds you can use within there.
Let's talk about that. What is a target date? Can you explain that?
So target date fund, many of you have probably actually seen these in some way, shape, or form in your 401k plan. Many 529 providers allow access to something similar in their plan. The way it functions is while your child is younger, so let's say your son or daughter is just born, you put money into a 529 within a target date fund. That fund is going to be more aggressive while that child is younger. So thinking of stocks to bonds, heavier allocation to stocks, not so much to bonds earlier on. The nice thing about that fund is it's going to get more conservative as we approach the age of 18, right?
Yep.
Really, when your child would start to have a need for these monies. And we want that because obviously there's volatility in the markets. We know that in the long term, that's how you make money in the markets, right?
Mm-hmm.
Anything can happen on a short-term basis. So making sure that the investment is getting more conservative, more liquid as you reach closer to that goal, in this case 18. That's what those funds are designed for, and
Yep.
they're excellent tools, especially for hands-off investors, right? People that maybe don't know a ton about it, but want to make sure the money's in something that will grow, but also be somewhat managed
Yeah,
along the
and
way.
it's appropriate and
100%.
diversified as well.
Yeah.
I don't like using this term in our industry, but this is the one time I tend to use it when we're talking about target date funds, and that's set it and forget it,
Yeah.
right? This is the one investment tool where you could comfortably feel that you are always in a good allocation
Mhm.
because it's invested for a particular date.
Yeah.
And so that's a fine way of doing it. You can also do it, to your point, a la carte,
Yeah.
right? If you want to build a portfolio like that. Now, when we're talking about 529 plans, inevitably the first question that comes out of mom and dad's mouth, or grandpa or grandma's mouth, is what happens if Billy doesn't go to school, right? What happens if Susie doesn't go to college? What happens to that money?
Yeah. Well, I get that question all the time. And it's something even I think about myself because you really, as parents, you can try to influence your kids one way or the other, but they end up being independent people and make decisions on what they want to do with their life,
Yep.
right? And so it's something we have to consider anytime we look at these accounts. Up until really, I would say the last 4 or 5 years, restrictions are pretty tight on 529s, and really they are earmarked for education, right? Specific
Mm-hmm.
expenses. But the government has really broadened what falls under that umbrella now, right? So even things like trade school, right? So if your kid wants to become an electrician, a plumber, something more hands-on, doesn't really want to be in a 4-year degree and kind of go through the regular book works,
Yep.
that route, then trade schools are covered for certain qualified expenses
Yep.
now. K through 12. So maybe you're sending your child to a private school where we know that's expensive too.
Sure.
Books, room and board, tuition, even off campus apartments up to, I believe, the amount that can be charged on campus.
Yep.
So these plans have really opened up as far as flexibility goes on what they can cover, right? And then there has been very recent legislation put into place, for we'll call it kind of the ripcord, right? If
Yep.
if the child doesn't go to college and you have all this money saved, what do you do? Now you're allowed to roll some of that money out to a Roth IRA. So instead of being education money, it can be geared towards retirement
Yep.
investments, still for your child and for their benefit. I've had some families where maybe there's multiple kids involved, and we can actually change the beneficiary to another child on
Exactly.
that 529, and so there's a lot of ways to kind of combat that. At the end of the day, it's there's no perfect solution for it, but the legislation has certainly opened it up.
There's without a doubt. I mean, it has gotten so much easier to maneuver things, right? You just mentioned the beneficiary change. That to
Mhm.
me, in my practice, is probably the most common way we deal with that,
Yeah.
where Billy won't need it all or doesn't go to school or whatever, and so we just simply change his account to Susie, right?
Yeah.
And so it's very easy to do. It's just a simple form. You can do that all day. I've actually seen circumstances where grandma and grandpa have 529s for their grandchildren. Billy doesn't go to school, so there's money left over, and they change the beneficiary from Billy's name to grandma's name
Right.
because she takes, knitting classes at the local,
Mhm.
community college. So she actually was able to use Billy's 529
Right. Right.
account for her own bill. So it's pretty cool. So changing beneficiaries very easy to do.
Yeah.
To your point, there's a lot of costs, whether it's for K through 12, regular 4-year schools, 2-year JUCOs,
Right.
grad schools. More than likely there's going to be some sort of educational need. So it's very flexible in that regard. The Roth rollover option is really cool, very new.
Yeah.
So there are restrictions, but that's an option now.
Yeah.
Um, Also, if Billy or Susie gets a scholarship or goes to the service, there's ways of getting money out of the 529 without any taxes or penalties in that regard too. But ultimately, to that point, if none of these things occur, and if you have to take that money out and it's not for a qualified educational expense, the worst case scenario is you would owe taxes and penalty on the gain.
Right.
So not what you put in, right? Not the contributions, but simply on the gain. So if you think about this, if you open up a 529 plan for Billy as soon as he's born, and that money has grown for 18, 20 years, 22 years, whatever, and there's money left over,
Yeah.
you've had 18 to 20 some years of tax deferred growth. That tax deferred growth in and of itself is probably going to take care of the taxes and penalty that
Right.
you're going to owe on that gain. So, in my opinion, if there's any remote possibility that this money is going to be used for education, 529 plans with the tax benefits that you're getting and the investment flexibility, it's a great way of going.
I'm with you. I think it's an assessment of risk, right? So the risk of not doing anything and not having that money versus the potential chance of not being able to use it for anything. To me, it makes a lot more sense in most cases
Sure.
to implement the plan for
Yeah.
the child.
One other thing I have seen too, and this is, as I've grown in my career and our clients are getting older and the students are getting older, if Billy has money left in his 401k, for example, he's now 25, 26, there's still money in there. Maybe he gets married and has children.
Mhm.
You can change it from Billy to Billy Jr.
Right.
And so now this 529 through the beneficiary change options, it almost turns into a generational educational account where it just is flown,
Yeah.
through 3 or 4 generations potentially.
And speaking of, I was just going to say on the as far as generations go, something we see a lot in our practice. We have a lot of grandparents that are interested in providing funding towards a grandchild,
Mhm.
right? As far as education goes, so that's something we see a lot. And I think grandparents are in a different stage of life. They've kind of made it a long way into their retirement. Maybe retirement's not a concern
Mhm.
and more along the lines of gifting is. And so a lot of times parents and grandparents will work together.
Yep.
Up until a couple of years ago, grandparent owned 529s were somewhat frowned upon because of FAFSA rules,
Yep.
financial, hurting the financial aid eligibility. Now, with recent changes to financial aid, it opens that up a lot more for grandparents to really be able to contribute towards a child's goals.
That's great. And one last thing on 520s, and we'll move on to another potential savings vehicle, but very flexible on who can contribute to it,
Yes.
right? You could own it for your son, but really anyone can contribute into that 529
Yeah,
on your son's behalf. So
Yes.
pretty cool with regards to that as well.
absolutely.
Hypothetically, if a parent or a grandparent comes to me and says, "Hey, I want to put some money away for Billy, but I want it to be earmarked for something else. We have a specific goal, whether that's a car or a wedding or senior trip or something like that,
Right.
that is, or braces, right? Something that is specifically not school. One of the other vehicles that we have seen and used in the past, and they were used more often, I think, years ago, but it's a trust account, whether that's a UTMA or a UGMA. This is a trust account,
Mhm.
right, that can be opened. It's actually owned technically by the child, okay? But there's a custodian involved, or think of it as almost like a trustee, someone that's in
Right.
charge of that account, someone that makes investment decisions on that account. This is another vehicle where you can have open investment flexibility. So
Right.
you can pretty much, invest in whatever you want. So there is that risk, that we have to consider, the investment decisions we have to consider. There's a little bit of a tax benefit in that is the child's account. So theoretically, any income or dividends, things of that nature that would be amassed in that portfolio flow through to the child. So there is a little bit of a tax benefit because theoretically
Right.
the child's not working,
Yep.
doesn't have a lot of income, and it can come out of that account pretty much for anything, right?
Right.
Anything for that child's behalf. And so there is a lot of flexibility with regards to that. Now, the one issue with these accounts, you know where I'm
The
going.
main one, yeah.
Yeah, the main issue is that age of majority, and it depends on the state, but here in Pennsylvania, that age of majority most of the time is 21.
Yep.
Okay, so at age of majority, that UTMA, for example, is no longer under the control of the parent or the guardian. It is now Billy's,
Yeah.
right? And so this 21-year-old now has complete control, whether he knows it or not, whether
Right.
the parents want that or not. Billy now has complete control of his UTMA. Okay, so that's a concern for a lot of people.
Yeah. I would say that's a pet peeve of mine, right? And everybody approaches this and looks at this a little differently. As far as our practice goes, I would say compared to other education or child savings accounts, we probably have the least amount of UTMAs, and it's for this concern, right?
Yep.
I was 18 once. You were 18 once, right? And I'm sure as all as
Long time ago.
parents, we know 18 is the legal age, right? In PA, it's 21 for the UTMA, so
Hmm.
it's a little further out. But
I was 21 once too.
21 once, yeah. So, kind of thinking about that and, knowing that you put money away for years and years, you've invested it, and that's your hard-earned dollars, right? Um, Only to not really know what your child will do with it, right? Maybe
Yep.
they do something very constructive, and so for some people, it's a good vehicle. Some people own it in tandem with a 529. We'll talk about that kind of stuff later.
Yep.
But yeah, that is why I think a lot of parents I talk to shy away from it, just because that money is the child's. At in PA, it's age 21, and it's a little too soon for most people.
Yeah. And as you might imagine, I think every advisor that's been in the business for a little while has that horror story, so to
Mhm.
speak, where mom or dad diligently put money into an UTMA, and everything is good and gravy, and we have some growth in there, and everyone expects Billy to grow up to be a responsible human being, a responsible adult.
Right.
But at some point, Billy finds out that account is his, and he
Yeah.
takes it and does something really stupid with it.
Yeah.
And you really can't do anything as
Yeah.
the parent. Once the child reaches the age of majority, it is theirs.
Yes.
Mom and dad have no control over it.
Yep.
So if Billy calls me and says, "Hey, I'm 21, give me my money," we have to give it to him,
Right.
right? And so that's the one risk that you run with those UTMAs or trust accounts in general,
Mhm.
is you have no control once a child reaches the age of majority. One question I always get is, well, can I take it out and move that money? And the answer is no. When you're making a contribution to one of these trusts, it's irrevocable,
Yeah.
and that money can only come out for the benefit of the child. So
Yeah.
keep that in mind. If you want to have flexibility on how you use it, that's about as flexible as it can get.
Right.
But you also lose complete control at age of
Absolutely.
majority. So one of the ways I get around that, okay, is the fourth option
Mhm.
with regards to saving for kids, and that's simply by opening up a non-qualified account. I like to keep it in mom or dad's name or joint, okay, but you earmark that. You kind of have an accounting, a mental accounting,
Right.
that account is for Billy, right? It's in mom or dad's name or both. You can invest whatever you want. There's no contribution limits or anything like that, like there are for 529s. You can buy whatever you want, theoretically, from an investment standpoint. You can take it out for whatever you want. But the nice thing is, this is your account. This is
Exactly.
mom and dad's account.
Mhm.
You have just mentally accounted for that account to be Billy's,
Right.
right? We can actually also nickname that account,
Yeah.
right? So that's mom and dad, but it's for the benefit of Billy.
On your statement or on
Yep.
the online
So that
app.
that account is for the child. But what's nice about this strategy that you don't have in the UTMA is that you have complete control forever,
Absolutely.
right?
Yeah, and I'd say we, compared to the UTMA, have substantially more accounts that are simply just earmarked for children. Whether it's alongside a 529 or just in general. This gives you the ability as the parent to say, well, maybe I want this to be for a college graduation gift, right?
Yep.
Um, Still the same investment flexibility to your point. Only somewhat of a downfall is that you're paying the taxes for the interest and dividends at your own tax rate, right? Which for parents, of course, having all the income on the return is a little bit higher most of the time, of course. But definitely something we use in our practice a lot more frequently than the UTMA account. The only other piece I would add to this, some parents talk to us about, what happens if we pass away, right? And of
Mm.
course, we're always talking about, maybe a topic for another episode, the legal documents side, estate planning side. Certainly, you want to have those things in place that can help direct assets like this. But oftentimes, we can have what's called a transfer on death designation
Yep.
on the account. And a lot of them actually enable you because some parents will say, well, if something happens to me, how is my 5-year-old child going to receive the money? But there's actually a way to name a trustee on there where we become similar to an UTMA account until the child is of age to have the money. So it's a way to earmark the funds, but also if something, God forbid, happens, a way to leave that money how it was intended to be for the child.
And that's a great point. That is another topic we're definitely going to have to talk about, just estate planning, but also incorporating trust language for minor children. We get asked about that quite a bit as well.
Mhm.
So you're on the hook. You have to come on again. Last point on that, just earmarked type of account, in mom and dad's name. there's a great line. I couldn't tell you who said it, but there's a great line that sometimes the best kids account is actually with no kids account at all.
Right.
Right. You don't have the kid anywhere near that account. It's just earmarked for that. So something to consider. Those are traditionally the 4 ways that I tend to, suggest to clients how to invest for kids. Again, just a traditional savings account, 529 account, the UTMA or the custodial account, and then just an earmarked type of taxable account. Is there anything else that you might consider?
The only other thing I can think of would be what's called a Trump account.
Oh, we're going to the Trump account.
Yeah,
Brand new.
brand new, and we're
Okay.
getting a lot of questions on this from clients. It's a new type of account, like you said, brand new type of account,
Yep.
where we're still actually kind of getting more and more details as they've released the legislation. But the general structure is, for children born between certain years, I think it's 2025 and 2028.
January 1st of 20, I have it written
There
down
you
right here,
go.
just in case. January 1st of 2025 and December 31st of 2028. Those are the kids that are eligible for the account with the
Seed
government
money. Yep.
benefit. Yep.
Yeah, and so is actually a way to receive what's called seed money from the government. I believe it's through either a tax credit or some form of tax return that goes directly into
Mm-hmm.
this Trump account. And it functions a lot like an IRA, right? The account can be funded by a parent. It can be used and grown towards more. I would say more retirement is when I look at these accounts. It is kind of where I see them setting up to work well. But there's other uses for them. We're still getting information. Of course, these are brand new, like you said, but something we'll definitely have our eyes on in the coming years.
Yeah, I've gotten asked a couple of times about this so far. Quite frankly, it's so new and it's evolving as we speak. So we almost have to punt. But there's going to be certain custodians, only certain custodians that are approved to do this. Obviously, there's a very narrow window of children that are going to be eligible,
Right.
at least for the seed money. They're actually, apparently, you can be eligible to open the account at broader ages. However, for the seed money, it's those dates we mentioned earlier.
Exactly.
Again, as I understand it, anyone can contribute to it. So you can actually potentially have an employer can contribute to it as well, and it grows tax deferred, and potentially, as they're saying, it could come out tax free for various things, and some of those funds, the funds can be theoretically used for education, first home purchase, perhaps starting a business.
Yeah.
Right. And so there's going to be some really interesting things that these funds can be used for. So we're really on the cusp of these Trump accounts. As you know, as you're finding out, it's evolving. So, but it is something that we're probably going to have it's going to be a new tool in our toolbox at some point as well.
Yep.
So, I think there's a lot of different ways to save for kids. The point is, every dollar saved and invested is going to be better than not.
Absolutely.
Right. Every dollar you can save and put away, it's better than not. Real quick, just to have a little fun with you, Mitch, since you're here, and let's play a quick little game, right? So I'm going to give you a really quick scenario, and maybe you tell me what account you would use in that scenario. So, if the parent wants full control and that's their only goal, they want to make sure they have control. Which one would you go with?
I would probably say an earmarked brokerage account. You could also throw the 529 in there maybe as well, since it is technically in the parent's name, really for the benefit of the child though. But to that question, probably the brokerage account that's earmarked.
Fair choice. Good answer. What if you want to have the most tax efficient vehicle?
The 529 is definitely going to be your go-to there.
Okay.
I mean, the money can grow if it's used for education expenses, qualified education expenses down the road. It can grow 100% tax-free and come out tax-free.
How about if you want full flexibility for the child? You want it to be able to be used for anything.
I would say the UTMA is good for that because at that point it's going to go to the child at the age of majority, and that's theirs, and they can use it for anything. So that's how I'd respond to that one.
Okay, that's a good one. I guess that the dedicated brokerage account could do that too,
It
but
could, yeah.
you get a little bit of a tax benefit with the UTMA.
Yep.
And that it's the child's tax code. Last one. What if you're just putting a little bit of money away and you're probably going to need it back very shortly? Which one would you do there?
We would go the piggy bank route or the savings account, just short-term savings at the bank. Keep it liquid, keep it safe. Just put it aside, and you can have it for short-term needs.
Love it. Good answers.
Yep.
There's no right or wrong answer, but no, good answers. So
I'll wait for my score after.
there you go. You're off the chopping.
Yeah.
Well, thank you. I appreciate your time and your expertise, your willingness to have a discussion. So, we'll have to get you on again.
Yeah.
Okay.
Thanks, Duke.
You're welcome. So once again, the Beyond Your Money podcast is designed to help educate, inform, entertain, and enlighten our clients, just to help give our clients the tools and resources they need to make good financial decisions. So again, it's your money, it's your life. Take control.